Welcome to the Retiring Well podcast. My name is Charlie Jordan. I'm your host, and I am so glad you joined me today. Our mission here at Retiring Well is simple. We want to help you do just that, to retire well. We're going to look at more than just the money and examine multiple aspects of life and retirement and how your wealth can be used to improve your life and the life of others. This is Retiring Well. Well, hey everyone, it's Charlie. It's good to have you again today. And we're going to be doing some listener questions today and have with me one of my good friends and fellow partner at CI Private Wealth, Brett Covert. Brett, how you doing today?
Hey, Charlie, I'm doing well. Glad to be here.
Awesome. Well, Brett is just an amazing advisor working with business owners, but in particular, his specialty is working with dentists and orthodontic practice owners, and has a lot of specialty in that area. And really excited, Brett, to have you on today and answer some of these listener questions. So you ready to go?
I'm ready, sir.
All right, let's do it. So the first one that we have comes in from Bill, and Bill says, I keep reading that high dividend paying stocks are a good way to generate income in retirement. Would you agree with that? So I'm going to let you start with that one, Brett.
I think this is a question that doesn't surprise me for a few reasons. One thing that comes to my mind is I think when the market's a bit volatile, our clients are seeking, less volatility. And I think historically, dividend paying stocks, an insulation, shock absorber, if you will, within the portfolio. High dividend stocks can be a way, but it shouldn't be the sole way to generate income in retirement. I think a better response, however, would be make sure we take a step back. A few issues that come to my mind, I'm sure yours too, include thinking about Bill's current investment allocation and how to loading up on high dividend paying stocks. What does that look like given what he currently has? And then another is risk tolerance in addition to, other things that we think about. Some of my prior research that's kind of top of mind pointed out to a few things that I thought was interesting. Over the last 50 years and then some, fewer and fewer companies are actually issuing dividends. And so if you have a dividend heavy strategy, you are perhaps by definition sacrificing some level of diversification, because if fewer companies are offering a dividend, then you're probably, adding some diversification risk somewhere, maybe some concentration in certain sectors. The other thing, was there's also some research that there isn't exactly strong evidence that high dividend payers or payers of dividends altogether showed strong outperformance relative to non-payers or low payer of dividends.
Yeah, I think when you're talking about someone that's in retirement that's looking for income, first of all, it hasn't been there in the traditional sense from, bond yields or cash or CDs or equivalents like that. So I think there's been a desire over the last decade plus to find ways of creating income producing assets that may not be quite as volatile as what we think of when we think of growth assets like technology stocks, et cetera. So I think there's a little bit of a finding the holy grail here in some cases where you're trying to find income and you're also trying to get some growth, which makes sense. I mean, I would say that a dividend paying stock strategy for someone who can handle the volatility of stocks themselves has been a much better place to be than in a bond portfolio from an income production standpoint. That being said, I agree with you. I think the diversification here is key. Nothing should be a sole strategy for producing retirement income. I think the big thing is to start with what do you actually need from your portfolio and really think of it as a total return approach. I think that it's easy to look at just the high dividend. It's easy to look at the yield, but forget about the fact that you may be buying something that has already been bought up considerably because everybody was looking for that yield and buying lots of said stocks. So I would say to Bill that it could be a good way to generate income, but is that congruent with the rest of your financial goals? Does that work with your risk tolerance? Does that fit into your overall allocation? So again, in a vacuum, yes, you can produce income with a good quality stock, But at the same time, does that fit for meeting all your needs? Are you planning on holding that indefinitely? What is the exit strategy of that stock? How does it fit into your overall portfolio? So this is probably, like most things, the ultimate it depends answer. But I do think that high dividend paying stocks are a decent way to create income. But I will say that their value is probably decreasing given the fact we actually are going to start seeing yields out of fixed income securities at some point. So
Yep.
we'll wait and see whether or not that strategy still holds up as well as maybe as it had been over the last decade or so. Let's go to the next one. This one is going to be from Mary. And Mary says, my husband and I want to spend more during the first 10 years of retirement, mostly traveling, while we were still healthy enough to do so. So how do we plan for this, knowing that it may be above our safe withdrawal rate? So first of all, if Mary's talking about safe withdrawal rate, she's read an article, she's heard an advisor talk at some point. But the question here is, hey, we're ready to go, we're uh, ready to spend, and we know that it may be a little bit over our sort of that safe level. How do we think about that? How do we plan for that, knowing that we may be spending a little bit more? What would you say, Brett?
Well, I think it's great. I've heard some talk about the retirement smile in retirement from a spending standpoint, where spending, typically can be more elevated initially because there's things, deferred satisfaction, that you want to do. And you get that out of your system. You do that for a handful of years, but eventually you take the cruises. You hope you do the things that you've sacrificed and not done, and then eventually there's some paring back of those expenses, maybe some leveling out, and then expenses start to increase a bit, perhaps, later years, later stages in retirement due to medical expenses. So first thing that I would actually tell Mary is, awesome. I love the fact that you're declaring what's important to you. I mean, take a page out of Retiring Well, Charlie, and what you're leading and talking in a big way about here is that retirement, and the work that we should do in the industry, should go well beyond, do you have enough money, and actually designing a retirement plan where, with your newfound excess time, how do you want to spend it? And typically, yes, it costs money, but spending more money up front, which, let's take a step back, there's no longer length of time that a client's portfolio needs to last than in the earliest years of the client's retirement. Right? They have the most longevity and theoretically the most longevity risk, with a whole host of unknowns. But while you have your health, and man, if the last 2 years hasn't provided for, perhaps for some, my heart goes out to those where they've truly suffered in a big way, losing loved ones, maybe suffering health issues. But for those that maybe haven't, and while they have their health, desire to want to travel more, I love it. And it takes me back to, Charlie, that retiring well aspect. You got two sides here of money, technical and personal. And what I'm hearing in a big way from Mary is her kind of speaking to both. Personally, we want to travel more, love it. But she's also heard a bit about this safe withdrawal rates, which takes you and I back to some of the work that Bill Benyon did back in the early 90s about the 4% safe withdrawal rate. A lot more for us to unpack here, but what comes to your mind, Charlie?
I think there's a sense that if people were running a road race, that they have to hit the curves just right. Like they have to run the perfect race in order to have done this successfully. And I think many advisors in our industry can exacerbate that desire to kind of get it all perfectly right. And that probably is going to go into a lot of these questions that we answer. But when we're talking about safe withdrawal rates, those are meant to be some guardrails for us. They're meant to give us a sense of what is sustainable long term, but it also really isn't that you shouldn't spend more than that in any given year. It really is a function of this is what you can do over a long period of time and have a high level of degree of success, knowing one of the biggest variables is going to be investment performance. So you may get the best 20% investment performance over that period of time, and you're able to spend more. You may get the worst 20% investment performance over that time, and you may need to cut back. I think the best way to look at this for Mary is if you spend over and above the technical calculation of your safe withdrawal rate. It increases the likelihood that in the future you're going to have to make an adjustment to that spending. That's okay, because we have to balance this. I mean, we should be using money in a way that improves our lives. And my personal hope and desire for all our clients is to live a life of purpose and of satisfaction, and use their money in a way that helps really support that. And so I would say, Mary, just like Brett did, that's awesome that you have plans. That's awesome that you are looking to utilize your wealth in a way that's going to bring you satisfaction. If things don't work, things that are outside of your control don't work out like you want them to, you may have to make some adjustments. And that is okay. That is okay. You don't have to run the perfect race. Every now and then, we're going to take a wide turn. Not going to crash. We're just going to take a wide turn. It's going to cut a few seconds off our time. It's really okay.
What I've seen a lot of is what I'll call dynamic spending, where I've had an agreement with the client, with some. They want to do more, which involves costs, and it's at the kind of the front end of their retirement time span. Great. But there's an agreement, and the agreement is while the market is good, and if you're spending more, usually using market excess profits that you're receiving, on one end, because we've seen kind of outsized returns, and you're choosing to spend that outsized returns. If there's a reversion and maybe more moderated returns in the future, or if we really needed some of those market profits in the past to help with managing around like longevity risk, making sure you don't outlive your money. Well, then again, this agreement means, and when things are less good, and if it continues for longer, then we need to be reflecting and getting back into your plan, and that you need to be flexible, Mr. and Mrs. Client, with making some of those adjustments. So it's kind of the upfront agreement, and we're getting back into their plan, and we're rerunning the numbers to make sure that we're not introducing too much likelihood or risk of them outliving their money. And so I have two clients that quickly come to my mind where that's been the agreement. Is they've had an awesome last 10 years. They have done some things while they had their health that they loved, but they said, Brett, when we hit, or when we need to pare back, we have a lovely home and an awesome back porch. And if we have to spend more time drinking lemonade and sitting on the rocking chairs, just reflecting on those trips and asking the grandkids and children to come see us at that time, we're okay with that. And that'll certainly help out the budget. And we're absolutely open to doing that. And I think that's great. I think it's great.
Yeah, you've probably heard this before. I don't know who came up with this analogy to begin with, but there, the three sort of phases of retirement. There's the go-go phase, there's the slow-go phase, and there's the no-go phase. And I don't know who to attribute that originally to. I've seen it a number of places, but that's very true. There's going to be a phase of your retirement life that you're healthy, you're able to go. That's what Mary's really speaking here. She says, while we're still healthy to do this, let's do this. And then there's going to be a time when you slow down. And other than maybe some healthcare costs or maybe some family expenses, you're going to stop spending money on some of the same things that you did before. And then the no-go phase, and I will say this too, most of the safe withdrawal rates that we look at don't include things like your home equity, et cetera. So a lot of people are sitting on, 6 figures of home equity value that could potentially be used to help support this lifestyle as well in the future. So I'm not going to tell anyone that you just have a blank check, go do whatever you want to do. Sky's the limit. Just enjoy life and don't worry about it later. That's not a responsible way to go about this. But with an analysis that you can do to make sure that you're in check, with some guardrails, and with the ability to say, yes, we can make changes in the future and have an advisor walk through that with us, to me, that's retiring well. So, and that's what we're hoping for. All right. The next one is from my actual good friend, Rusty. And he's going to ask us an inflation question, because why not? That's top of mind for everyone right now. And he says, I'm retired. My income streams more than cover my day-to-day expenses. I had what I thought was enough in investments to be comfortable, but will high inflation change that? How should I think about my portfolio in light of this high inflation that's not going away anytime soon? So Rusty gave us a little commentary there on what inflation is going to do. He said it's not going to go away anytime soon. We'll see what happens there. But I think the question here is maybe less about, just my costs going up, but how is that affecting my calculation? How is that affecting my sustainability when everything now is costing a whole lot more than it used to? And should I do something different to my portfolio in light of that? What do you say, Brett?
A couple of things come to my mind. The first thing, and I don't know if this is precisely Rusty, but when I hear that income exceeds expenses, then I actually, for the person, for the listener that's not tapping principal, I am much less worried about, because if we're just simply accessing income versus principal or corpus, we're talking now about putting a lot less pressure on sustainability because we still have assets invested and will remain invested. A few things that I would say is, some key tenets, if you will, is um, making sure that anyone isn't sitting on too much cash. Um, that's not going to do well. Having a good understanding again of your overall portfolio allocation, and making sure that you've got enough asset classes in place, different types of investments that will keep pace with inflation. Stocks have historically been a traditional great hedge against inflation. Real assets, real estate. And we talked about stocks and dividend equities earlier. The other thing that I've historically done in the past is saying, okay, Rusty, let's take a look at your portfolio and let's see how you're currently invested. And then when we get into the client's financial plan, what we've historically done, Charlie, is we've had various assumptions around what inflation will be using longer term periods of time to determine what those assumptions are. And for my client that's more interested in like current inflation, and if it doesn't subside or remain stickier for longer, I'm like, great. Then we can't control that. We may be able to control personal spending, which I maybe care more about than just overall inflation. So whether that theoretical basket of goods where inflation is sort of calculated against, that's one thing. But let's dig in and look at your personal inflation and figure out where you're spending money. And so we've got kind of a dual game plan approach. We're looking at the income statement, expense side of things, but then we're also getting back into the portfolio and doing some planning. And for some of my clients that are concerned about, inflation remaining higher for longer, it's like, well, let's make sure that we're accounting for probably higher yields in your fixed income and your other investments too. So we're taking credit and getting credit for that. But we're also doing some sensitivity analysis and playing with the interest rate assumptions and saying, okay, if they're going to be more elevated for longer, how is that, if at all, eroding your nest egg and how much assets you have? And are we introducing any additional risk in you outliving your assets? So
Well, I mean, you're right. The first part where the income is covering your expenses, that's a great place to be. I think the first thought is does inflation change that? For a lot of people, that's the insidious part about inflation, especially in retirees who may have a income that doesn't go up with inflation a whole lot. If they have a true fixed income and then their expenses go up, then that gap gets wider. So that'd be my first thought is, is that going to be the case going forward? Are you going to need to start tapping your portfolio to supplement your lifestyle as a result of this inflation? If that's not the case, I think you do have a lot you can work with here where obviously fixed income assets, bonds, et cetera, are going to struggle to keep up with almost double digit inflation. That's a very difficult thing to keep up with long term. The assumption being that we're hopefully not going to be living at this level for that long a period of time. But if your bond portfolio is yielding you know 2, 3, 4%, that doesn't do much to a 9% inflation rate. Over time, you hope those things continue to converge in the right way. Growth assets are where you're going to get some protection against inflation, but the cost is your short-term volatility, which we're certainly experiencing right now. So I would say, not if I said I didn't know Rusty, I would say that growth assets are going to be where you can protect yourself against inflation over long periods of time. However, let's make sure that cash flow deficit doesn't creep up because of inflation. So again, having cash is boring sometimes. It is losing to inflation every single day, but man, it serves a purpose, and it's to be there. And it's to be there for you, and it's available, and it has not gone down as other assets can when you need it. And so making sure that you have enough cash to cover that short to intermediate term period of time where that gap gets filled. All right, the next one is from Matt, and it is a question that says, is a QCD really worth doing since it's not deductible? So let's start with what is a QCD and take it from there.
Okay, perfect. So QCD is known as a qualified charitable distribution, and it pertains to IRAs and what you can do with money coming out of an IRA. And so you probably should pivot. I should probably pivot and talk about how it implicates or involves an IRA, and then we're going to get right back to the QCD and talk about is it worth doing despite it not being deductible. So I think most listening to this podcast know what an IRA is, an individual retirement account. And if you are an individual with a IRA, you are now required under current law to take a required minimum distribution upon turning age 72. We have the good fortune of, in some cases, working with clients that would prefer to not touch their IRAs. And so when they hit 72, it's like, great, now what do I do? I'm being forced to distribute this money. It's taxable. And for those folks that have other things that they're considering doing, they don't necessarily need dollar for dollar of all of those distributions. There is a strategy that they can consider doing, but that strategy actually begins at 70 and a half, which is kind of interesting. 70 and a half, Charlie, as you know, was the prior age before it was adjusted to 72, where
Right.
required minimum distributions began. So for some reason, probably just Congress leaving or good lobbying on behalf of charities. So if the required minimum distribution, the money that you pull out of your IRA, is payable to you, that's taxable income. And that can do a whole host of things, Charlie. If you're being forced to take income, it's increasing and perhaps pushing you in a higher federal, maybe even state income tax bracket. It may thrust you upwards and cause you to be phased out of other deductions that you're trying to take. And something that a lot of our listeners here may be, thinking about or already benefiting from is Social Security. If they're currently only being taxed at a current level, now, having to receive income from an IRA that they may not necessarily need could cause their Social Security benefits to be taxed at a higher amount. And so some of that undoubtedly is pertinent to a lot of our clients. And I think we also probably have a client base, we've seen this, that also are very charitably inclined. And so I think this is where QCD comes into play. And so again, qualified charitable distribution is simply a mechanism where money that you choose to pull out beginning at 70 and a half, or you have to pull out of an IRA beginning at 72, you do not have to receive and have that inflate your taxable income and be treated as taxable income, but rather you can bypass and have that amount up to $100,000 routed directly to one or more charities that you're interested in benefiting with your resources. And so this is a question that's also come up before. It's like, wow, so you're telling me that I don't get a deduction. And I think most engaged in philanthropy are accustomed to giving and getting a deduction back. Well, we're talking about a strategy to achieve a desire to be charitable. And yes, you don't get the deduction, but you also probably get something better. You don't have to recognize income that you otherwise would, and therefore the deduction is less important.
So let's clarify that for a little bit. So the qualified charitable distribution goes to charity. It doesn't come to you. So you don't take it in as income. Subsequently, you also don't get a charitable deduction for that going off. So it's a bit of a wash from that standpoint. But the real impact, as you're saying, is it doesn't affect your brackets. It doesn't push your income up. Where if you just gave a gift directly to a charity out of your other assets, you would get a charitable deduction for that. But when you think about a retiree, especially given where the standard deductions are for a lot of people, they're maybe not even getting the full impact of that itemized deduction on their tax return when they give to charity. So this is a great tool for a retiree as Brett mentioned, it's 70 and a half only. You do have this period from 70 and a half to 72 where you're actually not required to take anything out, but you can. You can do up to $100,000. And I would say that it's a great tool for those who are charitably inclined, of course. But I'd also say that it's an easy way for you to kind of reduce the impact of that required minimum distribution. And for a lot of my clients, what they do is they take $100,000 off the first part of their required distribution. Anything else, they actually go ahead and just send to the government in the form of a withholding, and just go ahead and know that that's done. It kind of reduces their ability or their need to do quarterly tax payments, et cetera. So I think it's a tool that could be used. Again, it's not for everyone because it's only if you're 70 and a half and older, and it's only up to $100,000. But I do think it's something that is worth looking at if that fits into your situation, even without the deductibility.
Yep, that's right. I think you've appropriately hedged there to say, essentially, make sure that you talk with your professionals to make sure this is the right route. That goes, I think, without saying. And the other things that I've seen is I think sometimes if we have a client or somebody listening, continue to work. I believe there's an inability to do a QCD if assets are still in a 401k. So that's something to be mindful of, and just making sure that the money that to be distributed is in the appropriate account where it's eligible, and then to make sure that where the money is going to go is going to a organization that can receive a qualified charitable distribution. So not all can. It's a bit more rigid, and so all the reason to just be having the right conversations to make sure it's appropriate.
I'll put a little bit finer tip on that last point. And a qualified charitable distribution, QCD, cannot go to a donor advised fund in general. So a lot of our clients use donor advised funds. We've talked about that on this show before. It's a Swiss Army knife of charitable giving. I love it as a tool, but this particular strategy cannot go to a donor advised fund. So it has to go to what I'll call the in charity user. So, and it doesn't have to go to one. It can be split amongst numerous charities. You can do it over a period of time, but lots of nuances here, lots of ways to get this wrong. So it's very important to work with your advisor, with your tax professional to make sure that you do this correctly, that it gets reported correctly. But I do think it's a strategy worth considering if you are charitably inclined and in retirement.
Good.
Awesome. All right. So this one is from Betsy. Betsy says, my husband and I are downsizing and moving into a townhome. We will have a very large amount of cash after we sell our home and buy the new one. Good for you. Is now a good time to put that in the market? So this is obviously there's a housing conversation here, but this is a conversation whether you get a lump sum pension or you sell your business and have a liquidity event. This is, I have a large amount of cash. Is now a time for me to be investing? What say you,
Absolutely.
Brett?
A couple things. So it's always a good time to be an investor. That's the first thing I would say. Investing is about time in the market versus trying to time the market. First things first. So let's take a step back and let's talk about like what just happened. Windfall of cash. I'm all about alignment, Charlie. You should own what's aligned with kind of known objectives or needs. So it's all about alignment for me. So first question that I would ask Betsy is there a need for any of this portion of cash in the near term? It could be for taxes owed. It could be for new furniture if they want to have nice furniture for a new home purchase. If cars are starting to, just not be as durable and there's some near-term purchases, remodeling projects, taxes owed. Let's make sure that we maybe even an emergency fund. So if we hadn't had an emergency fund before and we want to create it, no better time than to withhold that cash. That would be kind of step one, is we hold back and keep that portion, that swath of this windfall in cash, because that seems like it's very much aligned with those needs. Everything else, high level, then we have some optionality around.
Mm-hmm.
If we have any variable debt for some reason hanging out there in this increasing, market environment or interest rate environment, let's consider extinguishing, higher debt. And certainly there's all types of debt, but less preferential debt is higher debt and debt that doesn't come with any deductibility. And so that would be a consideration. And then, maybe I'm overgeneralizing here, but to me, everything else then maybe has a longer term opportunity to be invested. And I'm a big believer in dollar cost averaging. It's what can help overcome inertia and going from, okay, is today the right day to be invested? Is it tomorrow? The data is futile. And day to day, the market's like flipping a quarter in terms of whether it's going to be up or down. You're probably unlikely to be the neither the most successful investor in perfectly timing the market, and you're also probably not likely to be the most unsuccessful in just timing it incorrectly. And so if that's the case, then dollar cost averaging and choosing to commit over a reasonable period of time, 3, 6, 9, 12 months, work with your team, work with someone if you don't have someone that can help you go from being cash to being invested again. And dollar cost averaging is, again, in my experience, a way to kind of cut through the emotional, is today the day, is tomorrow the right day? It's going to be challenging, if not impossible to do so. But dollar cost averaging is a way to kind of work through that and choosing to commit to being invested, because it's about length of time of being reinvested.
This is where I come back to the running the perfect race. I think people think that we have to run the perfect race. We have to know the perfect timing to invest this. And what if I invest this now and it goes down? Well, first of all, it's very unlikely you're going to be investing 100% in the equity markets. You're probably going to have a diversified portfolio. Hopefully you have a diversified portfolio after you take care of debt and cash, like you mentioned before. And so you're not going to put everything, quote, in the market. This whole concept that I've heard before of decades versus days, if you're a short-term investor right now, is hard. It is really hard because you're just seeing a lot of turmoil. If you're a long-term investor and you take a step back and you look at what markets have done over 5, 10, 20 years, you start to say, what we're dealing with now is pretty normal. And it's really a marginal shift and change. And it's really kind of a run-of-the-mill bear market. And so what would myself 10 years from now want me to do with that money? Sometimes we get wrapped up in what we need to do now, what we're feeling right now. And I would say that, Betsy, either dollar cost average to kind of give yourself a plan to feel good about, or take care of your cash and invest the money. Because over time, the worst thing I think it could happen is, if you're a long-term investor, you've got your short-term needs met, if you're a long-term investor, I think the worst thing is you sit in a ton of cash for a long period of time. It doesn't work for you like you want it to. And you're going to look back at that and say, I wish I had done something a little bit different. But right now, it feels like the pain of losing would be worse, right? It's just human nature. Well, Brett, I do appreciate your time. This is always just hopefully valuable for people to hear the questions that are being asked, to hear sort of the answers that we are providing. In many cases, and in most cases, we would say that all of these are general in nature and don't certainly pertain to anyone's specific situation. So we've tried to answer those questions the best way we could, but as you could tell, we've always kind of come back to the best way for anyone to get the answers to these questions is to work with an advisor, knowing their personal situation. While we love to serve everybody, we can't. So we don't know everyone's situation. We don't know exactly their circumstances. And but if you are not working with an advisor, we'd highly recommend that you do so, to be able to walk through not just the answers to these questions, but how they fit into your unique and specific situation. So, Brett, I want to thank you again, my friend, and really enjoyed having you today.
Thanks, Charlie. I enjoyed it.
It's really important to recognize that your individual situation is unique to you, and that anything we discussed today should not be considered legal or tax or investment advice. But you may have heard this podcast and have questions or want to talk to someone about your personal situation. We have ways you can connect with our team. If you'd like to connect with an advisor or have any questions for us to answer here on the podcast in a future listener question episode, you can shoot us an email at retiringwell@brightworth.com. Also, one of my favorite things we offer is the Retiring Well Connection. It's a monthly email newsletter. It covers all areas of life and retirement, both the money side and the personal side. And we search for great content all over the web, pull together 3 to 4 pieces each month, whether that's a podcast, article, book recommendation, etc. Pull together things that we think our readers and our listeners will find interesting and valuable. So there's a link to subscribe to that in the show notes. So make sure you get your Retire Well connection each month. And finally, you're going to hear us reference the elements of retirement frequently around here. We've developed a tool to help you think through what matters most to you in life, in retirement, and where you can prioritize your financial decision-making to retire well. So to get your copy of what we call the 10 Elements of Retirement Self-Assessment, see the link in the show notes. And if you enjoyed this podcast, please help us by rating and subscribing so you don't miss any future episodes. That's all for us today. I'm Charlie Jordan. Have a great day.